I think you should be prepared to answer one particular question from investors is how long will it take you to deploy the money that I've contributed? Because investors want to know that their money is at work from day one. Welcome to Alt Investing Made Easy, where we explore the complex world of alternative assets. I'm Roland, a securities attorney, investment advisor, and your co-host.
And I'm Sarah, an investment advisor and corporate attorney, and your other co-host. We'll guide you through real estate, private equity, and more, making complex topics accessible.
Tune in for insights that empower your financial journey.
Let's make alt investing easy, one episode at a time. Welcome everyone to Alt Investing Made Easy. Today we have an interesting topic for investors and syndicators involved in commercial real estate. We're going to talk about the difference between open-ended funds and single asset funds. And this is especially interesting for people who have developed underwriting processes and teams that they've worked with over successive deals. Oftentimes people come to us and ask us, like, what's the next step? I don't want to keep going back to my investors each time to raise money for a new deal. Sometimes it takes too long and it's a distraction from underwriting good deals. So today we're going to explore the differences between those two and give you information about those differences and the things to consider if that's a step that you're considering taking. Hi, Roland. How are you today?
Yeah, good, Sarah. How are you doing?
Good, thank you.
Yeah, this is a topic that comes up all the time with our law firm clients, particularly ones that have been maybe doing single asset deals for a while and they come back to us and think, hey, could we create this pocketbook that just allows us to go out and find deals? So that's, this is both for the investors. We want to make sure investors can think about what it is that they're investing in, but we're kind of doing an FAQ for our law firm clients here as well.
So this time we're going to do something a little different than we've done before. And I'm going to take the role of a well-informed client who's asking Roland, our expert, about what would be involved if I want to move from doing syndications for single asset deals and commercial real estate deals and take a step into a different direction, which is this creating the pocketbook that Roland said, having an open-ended fund that can invest in projects at its own discretion, basically. So one thing I know that my investor group might appreciate is the kind of diversification that can be offered through this, and that's a point that we'll touch on. So Roland, shall we begin?
Yeah, for sure.
All right. So Roland, thanks for all your help with all of those 10 other deals that we've done together. Our single asset deals where we've gone to our investor group. And by now I have a great team and we have a really clear understanding of how to underwrite deals. I also have a really committed and loyal investor group that we've developed relationships over all this time. So I want to talk to you about some new ideas we've been discussing.
Okay, well, go ahead.
So we've done these single asset syndications. There are lots more opportunities. And if the market gets more competitive, it's going to be important to be able to move quickly. So we're ready to maybe do business in a different way than we have in the past. And we had this idea about an open-ended fund where we raise funds and then deploy them as and when opportunities arise. And we have the cash available to do that.
Okay, well, I think it would work. Knowing what I know about your business, you've got a kind of a replicable strategy, and really it would make sense to combine multiple assets into one fund. And like you're saying, give investors this diversification and then gives you some greater flexibility. The one thing that I would want to caution you about is there are some important distinctions between single asset syndications and these open-ended funds that we talk about.
So let's talk about those because obviously that's going to be really important. And the main one would be for us is how do the investors even put capital into an open fund? How is that different from syndication for a single asset?
Yeah, typically with the syndication for the single asset, we'll have the asset, of course, that we disclose specifically. It's a specific real estate asset. And then there'll be a closing. And then the investors typically fund their investment right before closing. And all the proceeds from the investment are used at closing to acquire the property, maybe create reserves for capital expenditures. But all the investors paying over the money happens at once, basically.
Hmm. And it's deployed very quickly,
Right. And
usually.
that's yeah, exactly. Immediately at closing, when you acquire the property, all the investor funds are used.
Right.
That's
So it's
contrast. It's
sorry, I was just
contrast.
going to say sorry.
Go ahead.
No, just as a promoter or a syndicator, that's comfortable because I don't have to worry about holding on to cash.
Well, right, and that raises an important point. We'll talk about this cash management policy here in a second, but the alternative to the capital contribution model is a capital commitment model.
So instead of contributing all the capital up front, I'm assuming what that means is that my investors promise to give me cash when I ask them for it.
That's right. Your investors will sign a legally binding commitment to fund an investment in the future upon written notice. And again, we're contrasting a capital commitment model versus a capital contribution model.
So that kind of looks like that means that if I have a new project, I still have to go and actually go to the investors and get the money. They've
Yeah,
committed
that
to it, but I guess things can always happen. And whether you want to get involved in, you know, pursuing the remedies if somebody doesn't pay, that kind of thing is a separate question. But it does sound like if you can just take the capital up front and deal with keeping that cash somehow, then you really have the most flexibility. Or and maybe that's something that my team would want to go with just in asking you these questions.
Well, it's just important to understand, and I think it may have to do with the sophistication of your investor group. If you
Hmm.
do implement a capital commitment model, your investors have to understand that these are legally binding obligations to fund the commitment. It's not just an expression of interest. And
Hmm.
so they're signing a contract that could be enforced by the manager. These are, like I just said, enforceable commitments, and enforceable so much so that they can sometimes be assigned by the manager the rights and the capital commitments, the commitment to fund the investment in the
Hmm.
future. They'll assign those to financing arrangements, and it becomes a really important thing for investors to understand that when they make a capital commitment, it's a real obligation to fund in the future.
Hmm. So that I could see how that could work in some contexts, but for just the sake of our discussion, let's assume I'm going to use uh, the capital, the model where we get paid up front,
The capital contribution
the
model.
capital contribution model. And in that context, what are my concerns if I take money and don't have I have one, say I have one project ready to go, but the whole point is that new projects will come up over the course of the life of the fund.
Yeah, if you have a capital contribution model and an open-ended fund, I think you should be prepared to answer one particular question from investors: is how long will it take you to deploy the money that I've contributed? Because investors want to know that their money is at work from day one.
Hmm.
So what they could say is, well, Sarah, I'm going to give you our investment today. When are you going to
Hmm.
deploy it? And you say, well, we're out looking at several different assets, so we think it could be 60 to 90 days.
Hmm.
And a smart investor, their immediate follow-up question is, well, what are you going to do with that cash in the interim? And so you have to articulate a cash management policy to earn some level of return on that money while it's sitting in the account.
So a cash management policy, I guess, do you it becomes part of what you work on as part of your investment strategy. It's almost like you have to manage cash in addition to managing the other income earning assets of the fund.
Yeah, that's right. And there are investments that you can make that are short term that earn, some a
Mm.
small amount of interest. They're relatively safe and liquid. I'm thinking an investment in a money market account.
Mm,
But just the one thing, an investor may be trusting you with their real estate investment, but they may think that they're better cash managers than you, and this could just be one more barrier to their investment in your fund. But it's really you know, it's just a decision that you'll have to make about whether you want to
mm,
use the capital contribution versus the capital commitment model.
right,
There are advantages and disadvantages to both.
exactly. So capital contribution up front and capital commitment. Okay, thank you. So we'll have to decide on that later as a team, but what other things should we be thinking about?
Well, I think really, as always, in all these private investment deals that we talk about and all the single asset deals that you've done, disclosure is the most important thing to think about, making sure that people know what you're going to be doing with their money.
Hmm.
But by definition, an open ended fund, you don't necessarily know about what specific assets you're going to be investing in at the time that your investors contribute money or make their capital commitments. So, what's important is that you give a good description of your investment strategy. The more specific that you can be, I think the better. There's a specific reason, practical reason for that. It's probably going to be easier for you to sell the deal the more specific you can be. Instead of saying multifamily properties anywhere in the United States versus multi multifamily properties located primarily in Central Texas, I have more certainty there, and it gives me more confidence to invest with you.
Right. So this goes back to what's important anyway about working with investors is disclosure, right? So this is like a more detailed disclosure of how you go about doing what you're going to do as opposed to the specifics of one's property and the various details of how you're going to address the problems or the issues that are related to that property. So that's exactly what we have. We have a good investment strategy that we've developed based on objective standards. And our investors keep coming back to us. So it seems like they like that. So it could be easy for us to replicate this investment strategy, and our policies are pretty clear, and it helps us move really fast so we can decide whether investments are good. And for that reason, it sounds like having money on hand would, that we can use for the benefit of our investors would actually be to their advantage.
Yeah, I mean, in these open-ended funds, the investor is investing in you. The investor is investing in the management, the confidence
Mm,
that they have in your integrity and the integrity of your process. And they're just saying, we know you so well. We know you're going to do a good job. We trust you to go out and find those assets.
hmm. Okay, that's really interesting. Um, so further about when we're talking about disclosure, what other elements do we need to think about? We have our investment strategy, but we also would want to talk about our track record. And in our track record, we have a lot of successes, but obviously we also have deals that didn't go great. Do I have to really tell investors about those?
Yeah, this is a really important point, Sarah, and it gets into something called cherry picking, and I think it's so funny. The law has these funny
Mm,
terms, but cherry picking is when you go up to the tree and you just pick off the ones that are nice, juicy, and red, and leave the ones that are maybe the worms in them or they're not quite ripe yet. And then you go out and you have the nice cherries, but leave the maybe unsightly or unappetizing cherries on the tree. And this is the same thing with you all, is that if there's any results that you're less than proud of, don't hide those, because if you do cherry pick and only represent your positive results as if those are the only results you had, then that could be a fraudulent misrepresentation. You could be held liable for securities fraud.
wow. Okay, that's really serious then. So, okay, I understood. So that means that in essence, honesty is the best policy, and maybe telling your story about the projects that didn't go well and what you learned from them is a way to keep investors on your side, instead of trying to pretend that you know you never ever had a problem.
Well,
So,
yeah, and when managers are talking about all their experiences, I think that transparency engenders trust, and I don't think that any investor can reasonably expect perfection from an investment manager. The investors generally want to understand how the manager is going to mitigate risk, and the manager can speak to that by speaking to their past experience and where things
Hmm.
didn't work out. But it's really important, and if I can get that level of transparency from a manager, and they give a good explanation for, even why a failure occurred, that's useful information for me as
Hmm.
an investor, and it helps me evaluate, who it is that I'm investing with.
So that is really important, but also sounds like something that a good fund manager would want to do anyway, is not be trying to um, withhold anything important from their investors so that you can build trust both ways. But moving on from that, what about the dollar amount? How much are we allowed to raise at all with this kind of a fund?
Well, the neat thing about Reg D, and we talk about these 506 offerings that we work under, 95% of the time, private offerings of securities. There's no limitation on the dollar amount. You could raise $1 trillion if you want to, but there is a
Mm,
practical limitation in the sense that you have to think about how much you and your team can adequately handle. What can you
mm,
faithfully steward? If you open up $100 million investment fund and you have five $20 million assets, can your team really manage those five assets, or just whatever it is?
mm.
That's going to be the important question.
So I think we have to give that some thought. And based on our current team and abilities, we think there would be a limit on how much we could realistically manage. So at least until we could expand our team, which takes a little bit of time as well. So how about the term of the fund? How long do we think about how long this should last?
Yeah, and I think that you can think about maybe two categories here. One that is truly open ended, a fund that you just expect, hey, we could operate this for 10 years, we could operate it for 20 years, but it's just the strategy is replicable and we could operate it continuously. That's one type,
Mm,
one kind of term. The other term would be more like thinking that you have a maybe a 10-year total horizon, and that in those 10 years, maybe the first 2 years you're accepting capital commitments from investors. Maybe during the first 3 years there's an overlapping period where you're not only taking those capital commitments in, but you're calling them down and deploying it.
mm,
And then maybe at year five, you think, well, by then we're going to be starting to harvest some of the gains and selling off the properties. And so maybe we say we have a 7 year term altogether where we
mm,
expect to start returning funds in year seven, but we also have an option to extend it for one additional 1 year periods after that. You don't want to be stuck in a position where you think, well, gosh, if we sold now, it's going to be 20% less than what we could get if we could sell it in a year from now. Sometimes you can kind of foresee what's going on in the market and make those timing decisions. But
mm.
those are really the two types of terms that you should be thinking about.
So whether we have a specific time frame or whether it's open ended. So I can see, for example, on our business model, how being open ended would be interesting because we do have a lot of successes and we see a lot of opportunity. So binding ourselves to a certain time period may not be what we would want to do. If we choose to do that, what are some other issues we should consider?
Well, yeah, if it's going to be open ended, and you're just telling your investors this is going to continue on forever, then they may think about, well, when am I going to get my money back? They don't
Hmm.
have a specific horizon. So if it's an open ended, truly open ended deal like that, you may want to think about offering your investors some liquidity terms.
And what do you mean by that?
Well, it just means that the investors will have a right to withdraw their capital after some, and almost always there's some kind of lockup period. And here we're really talking about real estate funds primarily. We've kind of
Hmm.
continuing this ongoing discussion. It's alternative assets, but really we're focusing a lot on commercial real estate initially. And there are different types of real estate funds, but really what you have to think about is the duration of the fund's investments will dictate what liquidity terms can be offered.
Hmm.
And maybe like a lending fund where the assets that you have or never would have a term of more than a year, maybe you could
Hmm.
offer better liquidity than if you have, some kind of, multifamily invest in rehab where you know that it'll be at least 2 to 3 years that you'll have to
Hmm.
hold that asset before you can, get sufficient liquidity. So if to and just to finish that thought, sufficient liquidity to in turn offer your investors the ability to redeem out all or portion of their investment.
Right,
So
right.
that's really important. There's no one size fits all there, and you just have to think that if you're going to be offering that right to redeem, then make sure that you have cash available to honor the redemption request.
So, what are the kind of limitations that we could put on that? Maybe we do give permit withdrawals, but we have to have notice periods, and after, if we don't have sufficient cash, even if we said you could, you know, withdraw funds, what do we do with all of that?
Yeah, and even in the most liquid real estate funds that I deal with, generally there's some kind of lockup period. Some, let's say a 2 year lockup period, and after that, maybe quarterly redemption rights, but you have to give at least 90 days notice.
Hmm.
And then you brought up an important point. One thing that we always include in the fund documents is disclosure and provisions that allow the manager to suspend redemption requests in the event that the manager determines that that suspension is in the best interest of the fund and all the members, including
Hmm.
not only the investors that are wanting to redeem out, but also the investors that are staying in. And the point here is that, again, you don't want to force the manager to sell an asset at an inopportune time solely to fund the redemption request. The manager, you should always have some flexibility to suspend redemption requests. But if you do suspend redemption requests, know that your investors, they may be maybe not mad at you, but they're telling you they want money back. So
Mm.
you really need to think about how it is you're going to, fund those requests.
It sounds like it's also something that's just you have to manage very much with your investor relations.
Yeah,
Um,
for sure. I mean, and it's so important. That's one of the biggest things that I try to encourage all of our clients with is that the investor relations component, and it really leads into just continuing disclosures becomes so important.
so, just as a separate question, quickly, if we have extra cash on hand and we decide that we don't have a project, can you like give extra money back to your investors,
Well,
like the
sure.
opposite of a withdrawal?
Yeah, for sure. I think that what we always include in the fund documents is you're right to determine available cash flow for distribution. That's
Hmm.
generally defined as gross revenues less expenses. It's pretty simple.
Hmm.
Um, and then also creating a reserve for contingencies and things like that. But once you've determined as a manager that you have cash flow that's available for distribution, then you start paying back your investors, and that's always a positive thing. People getting money back, they like that
They
generally.
feel good, unless they want you to keep, put it right back with you.
Right.
So all that makes a lot of sense. And it sounds like once you get used to it, it's different from the way that you run a single asset syndication. It's a little bit more complex in terms of managing your investors. But by this point, we feel pretty comfortable with doing all of that. What are some other things we need to think about? Is there a continuing disclosure requirement or anything we need to do on an ongoing basis after the funds open?
Yeah, and here you're a private company, so you don't have these disclosure obligations that a registered
Mm.
offering would have, like under the Exchange Act. And we've talked about this before. Under the Exchange Act, the public companies have to file 10Qs, 10Ks, 8Ks for any material thing that happens. But here, all of your disclosure obligations are really defined by contract. But I really do. Encourage all of our clients to sort of mirror those
Hmm.
Exchange Act reporting requirements, and it's only going to serve you. The angriest investors are the ones that think that you're hiding the ball from them, and you're
Mm.
not wanting to tell them about problems, or just going silent on them. They never hear from you, and it just raises questions in their mind. So I would really encourage developing a program for continuous disclosure, both whether you're doing a single asset syndication or particularly in the case of these open-ended funds.
Hmm. What about accounting? Do we have certain accounting obligations other than what, just keep the books?
Yeah, no, for sure. The one thing you have to think about, or the main thing you have to think about here, is having an accountant that's familiar with accounting for fund operations, and the issues here. You have investors entering at different times, exiting at different times, and also you're purchasing assets and selling assets within that time period. And so just measuring investor returns based on the assets during the time that an investor is invested in the fund. Um, there's some complications there, but it's nothing that a good accountant shouldn't be able to handle.
So it sounds like it is maybe the new person you need on your team is actually your accountant who's experienced with blind pool funds or open-ended funds. Maybe your accountant is, but there are some specialty areas there that need to be not overlooked.
Yeah,
So,
yeah. Just confirm with them, saying, "Hey, I'm doing a blind pool fund. If they have any hesitancy, then call us up, and we can put you in touch with somebody that can help you."
so I know that we've talked about all these matters in relation to commercial real estate, and that's the role of the client role play that we're doing here. But what about open-ended funds for other things?
Well, sure. That's a really good question, because it probably is more common to have open-ended funds, in the context of like a hedge fund. You think about
Mm,
hedge funds, they're investing in publicly traded stock, um, and they're employing a strategy that for sure is replicable. It's not related to a single asset, this particularly good deal that we found. I mean, it's a strategy that they're employing over and over again continuously. So really the open-ended fund, the hedge fund, I guess, is probably the most common type of
mm,
open-ended fund. Private equity, I would say those are more term bound. I would expect most private equity funds, they're employing a strategy. Maybe they're investing in multiple assets, but they're generally targeting a specific time period rather than a purely open-ended deal.
mm.
But for sure, you could have an open-ended fund that just is investing in different private businesses, and expects to operate those, and maybe just operates them for long term. And so
That's actually, it's interesting. That's something that we didn't highlight. We mentioned it at the beginning, but we didn't highlight it, which is the diversification. So even here with this idea of an open-ended fund for commercial real estate, it's clients that we've worked with who were working on these kinds of funds focus on that with their investors. They talk about the benefit of the diversification, and probably or potentially not just across, one kind of commercial real estate asset, like all multifamily, or, maybe there are a variety of projects that are mixed into different parts of the fund. And so that diversification element is maybe a good motivator for investors. That's something they're looking for. Then they don't have to do that themselves and go out and invest themselves in 10 different deals.
yeah, for sure. That is a thing with these funds, and it's not unlike a mutual fund, or
Mm,
ETF, where you're investing in a basket of stocks, and you think, well,
mm,
Apple's doing good today, but they may not do good tomorrow, and that the risk of that can be offset by investing in other things that will have
mm.
non-correlating returns or whatever. But anyway, for sure, diversification is a thing with these open-ended funds.
So, is there anything else we want to talk about on this subject?
Well, no, I think that that's really it, and I guess I would just leave everybody with a thought that it's something that we alluded to at the very beginning, is that I think that these are harder to sell. Clients
Mm,
that set these up typically have expressed to me that it's a little harder to sell, and I think the only reason is just because there's there's not specificity with regard to the assets that you're investing in. It's a lot easier for me to invest in something that I can really get my mind around and understand. I could go drive by the, whatever the property is and look at it ahead of time. But having an open-ended strategy that you're implementing, it just requires me to put a lot of faith in you. But I think, most of our clients wind up having that relationship with investors where the investors just have a lot of faith in the manager and more belief in the manager than the deal. This came up the other day when we were talking with Massive, that a good manager can make a mediocre deal great, and a mediocre manager can make a great deal bad. So
Right.
again, they're investing with you and the integrity, who you are, your process, rather than necessarily a specific deal.
So I think this is such an important topic, though, because there is the other advantage, which is if you're an investor who needs some efficiencies in your life and you do have managers that you really trust, then these funds are really good options to look at, because if you were going to enter into those same 10 deals with that same person anyway, it's almost the same thing. It just is committing to that in advance as opposed to a piecemeal basis. And maybe you're going to get a better return because they'll be able to move more quickly than having to go back to investors every time. So I think it's very interesting for investors to consider these kinds of funds. So,
Yeah, for sure.
um,
Well, that seems like a natural place to stop. I think we've addressed a topic here that's really useful knowledge both for investors and for fund managers, and hope that it's given our audience food for thought when they think about the different ways that they might be able to invest in commercial real estate.
thank you for watching, everyone. If you enjoyed this episode, please like and subscribe.
And remember, everyone, take aim with your alternative investing strategies.
See you next time.